Yes, we can.
Oh, good.
Yeah.
Okay, wonderful. I was a little concerned that maybe you couldn't, but anyway, thank you very much for the introduction, Chip, and really pleased to actually have the opportunity to speak with this group for a whole variety of reasons. But let me start with this, if I could. First of all, the Milner Agency has been one of the longest-standing partnerships at Genworth, and the various names of our company, I think going back really back to the first colony days, certainly this relationship is very tenured, has been very important to Genworth, and I think has been one that has worked together very, very well over the years. And I certainly want to thank Chip and Greg and Chad and the entire team at the Milner Agency, as well as the wonderful producers that are associated with your agency, who have continue to have an interest and support our company through good times and not so good times. And I certainly recognize that a lot has changed at Genworth over the last several months in particular. And with this in mind, my goal is to give you an update, share our strategy, and hopefully create more confidence for you and ideally your clients who hold and own Genworth policies in having really more confidence in our company. Because I know certainly over the last couple quarters in particular, and quite candidly, due to the rating agency changes, and I think all of you know that, I think most importantly, AM Best, who had downgraded Genworth from an A- status to a B++ status, has created a number of questions. And I think the questions that I have been asked, and certainly our company, have been fair, they have been warranted, and quite sincerely, I'm actually pleased about it on one level, because it tells me that producers and general agents who really reach out and express their concerns, ask their questions, and seek better understanding are doing two things. Number one is it tells me that they care about Genworth enough to want to dig a little bit deeper. And number two, they're doing their due diligence. And I think a professional insurance advisor ought to be looking at the 3 or 4 companies for which he or she represents predominantly on a quarterly basis, and making sure that they feel comfortable in who they're recommending and who they're really endorsing as product recommendations are made. So I compliment you for that. I think I think those of you that know me, and I no doubt many of you may not, I try to be very transparent, and I will do my best to be straight with you today. There may be questions you have that I cannot answer. If that's the case, I will make sure that you do get answers. Secondly, we are in the quiet period, so I'm going to be very limited in terms of what I can say about the future, although I will give you certainly insights in terms of what we are trying to do. So with that as a preamble, let me give you an overview of what we're doing, what we've done, why we've done what we've done, and all of that wonderful stuff. So first and foremost, we have been a company that has been very focused on life insurance, annuities, as well as individual and group long-term care, and linked benefits have also been an important part of our portfolio up until recently. And I do want to give you some insights today as to some decisions that were made around exiting the traditional life, annuity, and linked benefit space recently, and help you to understand how that decision was made. But I think realistically, the way that people need to be thinking about Genworth as we move forward is a company that has really declared its major, and its major being providing long-term care funding solutions, ideally designed to solve the financial challenges of aging. And I'm going to tell you why we picked that business over the other businesses that we were involved in a moment. I will also share with you a number of things that I'm very excited about in terms of what we're doing on the long-term care front. But in fairness to this group, and knowing that there are a number of people on the line who have sold life and annuity and TLC products with us, let me address the reasons why we kind of decided to exit the traditional life and annuity business. So if you kind of think a little bit about Genworth as an organization, and not unlike a number of insurance companies, we have had some capital restrictions on where we invest capital, over the last certainly over the last 3 years, maybe even 4. And I will tell you that while the life insurance business, and I really started in the life insurance business, as Chip kind of alluded to, and I have a passion for the life insurance business, and it's kind of always been part of what I've done. And you guys have done a lot of life insurance business with us, and particularly term insurance, which of course was what we were best known for. And I remember when I started with this company 8 years ago, I was asked early in the interviewing process, and over the first few months of my tenure here, what was my view on Genworth in terms of being a term insurance or a life insurance provider? And the answer that I provided to the company back then was, from an outsider's perspective, and I came from the Hartford before I joined this company, was that Genworth was a term machine. The number of applications this company processed was, certainly for a few years there, the highest in the industry. I mean, we were doing over 5,000 new cases a week, which made us the industry leader in volume, but it didn't make us the industry leader in profitability. And what was interesting to me is that this company was known for, I think, 3 things. Consistently very competitive rates. Number 2, very strong back office capabilities, so cycle times and processing were the service experience for the agent and for the client, I think, were as good as anybody in the industry. And then lastly, I think, we've been known for being very competitive from a compensation perspective. And so my conclusion was was always, I'm not entirely sure how you can be so competitive from a comp perspective and also be so competitive from a rate standpoint. And with the ongoing decreases in term pricing, which we saw for a lot of years, how you could possibly make money. And so while we've sold tons of policies, I will tell you that our in-force block of business is not nearly as profitable as many people would probably believe it to be. It makes money. The term business itself is typically a 9 or 10% rate of return product. For us, our results are lower than that, so it's not by any means a cash cow, despite the huge volume of term policies that we have on the book. So I would even say our term business is performing at subpar standards. And the analogy that I like to offer people, because they often find this surprising, but this is kind of how our investors would look at this, and quite frankly how our board would look at it. If I said to you guys and gals on the line today, hey, I got an investment opportunity for you, and here's how it's going to work, and I'd like to share it with you, and then on a rhetorical basis, I want you to think about whether you would invest in this personally or not. So here's how the deal is going to work. Number one is we're going to ask you to give us $2.50 for every $1 of premium we collect. All right, so we'll collect $1. You're an investor. You're going to put up $2.50, and you're going to do that throughout the course of the contract, because that is really what the reserve requirements are for term insurance products. And typically, you'll start to make money after about 8 years. So for the first 8 years, you're going to lose money. And you've got to be in this for the long run, because we're going to build this book of business, and presumably after 8 years, we're going to start to turn a profit. And then in the long run, you know, we would aim for 9 or 10% rate of return, and in today's world, that would be considered probably a home run. And but one of the things that happened along the way was that as term prices got lower and lower, it actually became viable in a lot of cases, as you know, to go to a client who had a policy for 5 years and say, you know what, based on current rates, assuming you're in good health, you may be better off buying a new policy. And so the level of replacement activity that took place in the years for which the product had not yet become profitable became problematic. And so where the insurance companies make their money on term insurances in the later years of the term duration. If you don't get there, that's a problem. Now, as rates have started to gradually increase over the last few years, you're seeing less opportunity to do what I just described. But as we go to our investors and say, look, here's how the term business works, and then they look at the long-term care business or the annuity business and they say better returns, there's a greater propensity for the company to want to invest in other products. So we had tried very hard to move away from selling term insurance, and we were selling significantly lower volumes by design, and we were also trying to become an indexed universal life player, partly because we like the design of the product and partly because it's just a much more capital efficient product for the company. And I will be very, very direct about this next comment. When we were downgraded, being a player in the IUL space, quite frankly, in my view, basically was a showstopper. Our ratings, in my view, created an environment where, you know, selling a product that typically has, you know, large premiums. Our average case size was $26,000 of annual premium. You know, there's just too many moving parts in that type of product for people, I think, to be comfortable marketing a B++ carrier. And I think the day our ratings were impacted, frankly, made growing and investing in the life insurance business not an attractive move for our company. The second part of the story then was, well, why did we get out of the annuity business? And the answer to that, and I'll share with linked benefits as well, and then I'll go right into what we're doing today. The story on the annuity front was this. You know, we were a pretty good annuity company. We had, in my view, fantastic products. Our portfolio had never been better than at the time we decided to exit that space. We had been making very good progress with our fixed index annuity portfolio, and we had some very unique features there. But one of our challenges certainly was that about 50% of our business came from financial institutions. And again, when our ratings were impacted, the financial institution arena, not exclusively, but to the most part, suspended the sale of Genworth products. Not necessarily to the same extent on the long-term care side of the house, but on the annuity side, it was a very big blow to the company. And based on the volume of business that we were going to be writing at profit levels that we expected, we just were not going to be left with a scalable business. And so at the end of the day, the company looked at that and said, you know, it's going to be very tough to play. It's so competitive, the space, and to try to invest, to try to regain market share was not an attractive option to us. Now, a number of people have come to me and said, well, what about linked benefits? I assume the reason that you took that product off your platform was because it was built on your life chassis, and therefore life's gone, TLC's gone. And I want to tell you that's not the reason. The issue with TLC, and quite honestly, I'm continuing to lobby to bring that product or some version of that product back to market. But the challenge that we had with the TLC product, which, by the way, I think was an incredible product and provided, in my opinion, the best value for the premium dollar of any product of its kind in the market. The challenge was that when we started to apply our company's long-term care experience assumptions to that product, it lowered the profitability of that product enough that it would trip our minimum profitability standards. And to make adjustments to that product where we could make a decent return would probably not make the product attractive enough for you to sell. So that product really needs to go through an overhaul before it can be brought back to market, and I'm hoping that will happen. But that's the honest reason behind all of that. So now you sit back and you go, okay, well, maybe I can make some sense out of those decisions. Why long-term care? You know, and when you look at the trends in the long-term care business, you have traditional product sales that have been declining. You have big growth with combo products and hybrid products, which, by the way, I'm really happy about because I think it's good for the industry. I am concerned, though, that there are too many cases where producers don't fully understand the pros and cons of what they're selling, and I think there's a big need for education on the pros and cons of the various solutions available. But for us, at the end of the day, we said, look, the reason we like the long-term care business is, number one, we are a leader in that industry. We have very little competition. And lastly, the market need just continues to explode. I mean, you look at you know, mega trends in the U.S. marketplace, and one of them is factored around the aging population. In fact, it's estimated that by 2030, that 19% of the American population will be over 65. And, you know, if you look out even a little further to 2050, you know, the baby boomer population, the youngest baby boomers will be 85 years of age. That's pretty staggering. The good news is that people are living longer, but the reality really is that most aren't financially prepared. And a sizable percentage of workers say they have virtually no money in savings and investments. And while I'm not promoting retirement planning today, many of you will know that if you're looking at stats on what the average household has in the way of assets upon retirement, the consistent number we see from whoever is doing the research is between $107,000 and $125,000. And if that is true, and whether it's true or not is kind of irrelevant, the bottom line is I think we'd all agree most people don't have enough to retire on. And therefore, if they suffer a long-term care event, they're bankrupt in 1 to 2 years. And all the research that Harvard has done, in case you're interested, would point to that sort of reality. You know, we know 70% of people over 65 years of age will need some form of long-term care service. So our view is we're very passionate about this business. It is a challenging business today, but we're committed to it and we're staying with it, and we believe that we can carve out and develop a very meaningful position in the marketplace, excuse me, being focused on long-term care funding. Now, in a moment, I'll open it up for Q&A, but one of the things that I want you to know is that we're going to get to that by offering different types of solutions. As recently as about a month ago, we introduced a new product, and it's an annuity. It's a SPIA. It's a fully underwritten immediate annuity product, which is in fact a alternative funding vehicle for long-term care. The target audience is 70 to 95 years of age, with the sweet spot about 85. And so for people who are looking at potentially going into some form of assisted living facility, it could be home care, but more likely assisted living or nursing home, and they're confronted with the financial decision on how are they going to fund their stay, one of the options that they're going to be given is an introduction to purchasing a impaired annuity. And just to give you an example, we've been developing a network of the largest national healthcare facilities across this country. And, one of their big concerns is, we're going to have somebody in a bed, but we don't know if they're going to be able to pay for it and for how long. And if in fact the person finds themselves in a situation where they receive Medicaid, the facility only gets about 50% of their normal revenue, and some facilities actually ask their patients to leave. So, we can provide them with peace of mind with a guaranteed income. And one of the cases that I was working on just a couple of weeks ago, we had a client who came in and said, look, I want to produce a certain monthly income to take care of my care, and we ran the numbers and gave him a quote, and it was the cost was $180,000. And then what we do as a standard practice is we run the same numbers through Canix, which you guys will know is the annuity quoting multi-carrier platform, if you will, and the cost was $300. And that just goes to show if you're unhealthy, buying an annuity should bear either less of an investment or it should produce a higher monthly income. So this is one of our innovative ideas to get at a different segment of the market and for those who can't qualify for long-term care. And we have other ideas on the table for new products that we plan to bring to market. So right now our focus is really creating new products to build a suite of long-term care solutions. A big part of what we're doing right now is to change the underwriting process. We just introduced what we call multi-stage underwriting, which is a very different process than we've experienced in the business. And the way that it works, and I'll just give you the very simple version of this, but if a client is 64 years of age or younger, we think that we can bring the cycle time down from about 60 days to about 15 days. And we're going to do that by getting to medical information, using more state-of-the-art information, and you're going to see us require on, we're going to basically eliminate lab work, so blood and urine for that segment of the market will go away. We may still ask for an attending physician statement if required, but we're going to really concentrate on making it easier to buy this product. So you're going to see us introduce an e-application later in the year. It'll be followed by a e-policy delivery capability, and our whole focus right now is how do we put out simpler products, more affordable solutions, so we can expand the market from mass affluent to affluent where we are today, which is what our current products are really focused on. But we also want to bring out new product solutions that really get at helping people get 50 or 100,000 of coverage on, and forced to have something, and target about a $1,200 a year premium commitment instead of where, most people are today, which is, anywhere from $2,600 to maybe $5,000 a year in premium. So you're going to see us go to have more solutions, broader market penetration, and become much easier to do business with. So that's what we're doing. And now what I'd like to do is pause and allow you to ask questions related to, our financials, related to our strategy, servicing our in-force policies, or whatever it might be. I'm ready to take your questions.
Thank you, Anthony. We've got, again, just as a reminder, if you would like to ask a question, you just hit the raise your hand button, and we will be able to call on you. I'm going to start by recognizing Talbot Carter. I'm going to unmute your line and let you go ahead, Talbot.
Anthony, thank you for your comments. I've been in the business for 35 years, and I have a lot of clients who have life insurance with you guys, and have clients who have long-term care. And I personally own some life insurance and also some long-term care contracts from me and my wife. I've got to tell you that you know, your plans sound great, but if you can't do something pretty quickly about your financials, I think the best plans in the world are going to be hobbled. And it concerns me for those clients who do own life insurance, but even more importantly, long-term care insurance. And when I talk about life insurance, I'm talking about both term and permanent life insurance, but the long-term care is something that is even more critical. We have seen companies over 35 years that have gone out of business, and in one way or another, normally life insurance policyholders have been taken care of in some form or fashion. Don't really know what happens when a long-term care company goes out of business. So, you know, basically to summarize 2 points. One, is there anything that you all can do to move past a 53 Comdex and do that fairly quickly, infusion of capital from somewhere? And number two, if things don't turn around, especially for long-term care policyholders, what is the outlook there? Because that's what we have to manage in the marketplace.
Yeah.
Those are the calls that we're getting.
Okay, well, Calvin, first of all, thank you for your question, and I appreciate the fact that you you own Genworth policies, and I do too, and in particular, you know, long-term care that I have with Genworth. But let me try to answer your question in a couple different ways. I think to be very forthright on this, you know, look, there could, who knows what's going to happen with this company over the course of time. It's difficult for me to predict, and what I can share with you is what I know today, and what I've been sharing with others along the way. And also, quite frankly, this information impacts the way that I look at my own, you know, assets, if you will, with Genworth, and policies that I have with the company. So first and foremost, you know, look, our ratings are not where anybody would want them to be. I think that you know, you've got to separate our stock price and our ratings from our claims paying ability. That's really, really important for that distinction to be made. And part of the reason I say that is that if our ratings were A- instead of B++, our ability from a claims paying perspective would be the same, because what we have in the way of reserves are not impacted by ratings or stock price. And so our company, you know, is well reserved in position to meet its claims paying ability. And hopefully, you know, the work that we did in the last, you know, 15 to 20 months around enhancing our reserves, particularly on the long-term care front, were a demonstration that the company, you know, continually reviews its reserves and increases the numbers or the reserves if necessary. So I think we've demonstrated we've done the right thing. Now, having said that, I can still understand there being some concern. And what, you know, the challenge with ratings is you can't really predict when your ratings may go up or down, and particularly we have to, demonstrate consistent performance quarter after quarter. And my guess is probably for the better part of 2 years before the rating agencies are likely to take action. And now, what I don't know is, could there be an event somewhere along the way with our company that could cause that to be a different story? I don't know. It's certainly possible. And we are looking at all of our strategic options today that that are designed ultimately to make our company financially stronger. So I think part of it is there's just you can only move so quickly on this stuff. But if you want to point to claims paying ability, the industry guidepost often is and most often looked at as your risk-based capital ratios. And you've probably heard this a number of times from different people in the industry. You want that number to be over 350%. Our RBC is 393% at the end of December 2015. And when you look at an insurance company, if you look at, if you're having concerns about, when is company strong enough, and the regulators don't even look at an insurance company for any kind of plan to improve the company itself unless the ratings get down to 200%. We've been in the 400 plus range for many years. So our reserving position today is particularly strong, and I would say I'm not worried about claims paying ability. That's not to say that I'm not concerned about things in our organization, because we definitely have to improve our sales. We definitely have a need to reduce the debt that our company is holding today, which is really held at the holdco level as opposed to the holding company level, not the subsidiaries, which is where really the reserves reside. And so from that vantage point, I do think there's good questions that you're being asked by policyholders. Are you safe with Genworth? Should I be concerned with their ratings? Are things going to get better, or are they going to get worse? I think right now that our position to meet our promises is very strong. But I would also say to you, as a professional advisor, you need to continue to do your due diligence every 3 months, and I'm happy to talk with any one of you on if you have questions or concerns. And I'm certainly willing to make our Chief Financial Officer available to you if you have a really important client that has concerns. We have the resources, and I think we have a good story to talk to. So I don't know if I think I've answered your question. I don't know if I've given you the answer you want, but if there's a follow-up to that question, please ask it.
Well, I think that it's, from a product standpoint, you can have a really good mousetrap, but if you have these kind of ratings, it is very difficult to sell that, whatever the product may be, to consumers. I think that's the bottom line. And then if that in fact is the case, you can get into a death spiral where basically if you're not generating new sales because of this problem, then how do you get out of this problem? And then the question becomes, what happens to the policyholders who own long-term care policies or permanent life insurance policies, and they don't have any place to go? So again, we hope, I think any broker out there who has done business with you guys, hopes that that you all figure a way out of this. But those ratings are killers as far as new business is concerned, and I'm sure that new business is essential to the workout plan. So that may not be what you want to hear, but I can tell you on the street that's how it works.
I think there's a lot of merit to what you're saying, Calvin. And so I think it's important for you to know. I mean, from our vantage point, we've had to really do some things that are difficult, which is lower our company expenses in a pretty significant way to align our infrastructure costs to the volumes of business that we're doing, because our sales have been impacted by our ratings. That is a fact. I will tell you, we had our best week in about 6 months last week on the individual side, and our group insurance business, for which we're investing in heavily, is having a very good year. And so I think realistically, to some extent, we're seeing some encouraging signs with the businesses that we're in today. It's going to take us a few years for us to rebuild this organization, but we continue to be committed to serving those policies that we have in force today, which we're doing on the life and annuity side, even though we're not selling new business outside of our impaired annuity product. And look, I recognize that there's going to be agents that'll simply say, I'm not prepared to sell a company that doesn't have an A+ rating. And we get that. But if we can sell profitable business, which we are today, and steadily grow our business and steadily add new distribution channels, which we're working on today, which is going quite well, we think that over the next 3-4 years we could put ourselves in a pretty good position. But the ratings are a challenge, and they're frustrating for me, and they're frustrating for people who really want to write our products. In the health insurance space, B-rated companies are very commonplace. In the life insurance business in particular, it's very hard to find an example of a company that sells any decent volume of life business that's not A-rated or better. And that was part of the reason we made the decision to really exit the life business, as I mentioned earlier. So, we do care about getting the ratings up. We've got some things we're working on to try to make that happen, but I can't make any promises around that. But I'm hoping, that will materialize. And, the most important thing that I can share with you today, I think, is right now I have no concerns about whether we're going to be able to honor our commitments or contractual obligations and pay claims. And what I don't know is, what are our sales volumes going to look like over time? And yeah, that is an important part. That is an important part of our overall strategy, but it's not the only part. And so there is definitely pressure on us to improve our business results. And quite frankly, some people might find this hard to believe, and I'm not so sure that we're, when we were selling a couple $100 million of LTC business, as an example, I'm not so sure we were making more money than what we're making today on a much smaller volume level. So, we've got profitable products. We do need to grow them. We're hoping that we will have enough producers and general agents that have the confidence in our financials that we can meet our obligations, and I just know that I'm not going to convince everybody in the world that they should continue to write Genworth business. Some people are going to wait and see, and hopefully will come back to us in a couple of years, and hopefully we'll have enough people that will stay with us during this transition period. But I respect your comments; they're fair, and we're doing the best we can. I don't want to be a B++ company at all. But it's far from saying that you're going out of business.
All right, Anthony, we've got another question from Nicholas Morano. Nicholas, I'm going to open your line and let you ask your question. Are you there, Nicholas? All right, he had forwarded his question, Anthony, so I'll ask it for him. He just wanted to know the new annuity that you mentioned, when is that going to be widely available?
Very good question. So we are rolling, it's in a pilot phase right now. And part of the reason for that, we're piloting this product in 3 distinct markets. And part of the reason that we're doing that is we've got some real sensitivity to selling SPIA products in the seniors market. The last thing you want to have is inappropriate sale being made and having it sabotage a new initiative that we've spent the better part of a year and a half working on. So we built a training program which is a day and a half in length, which is required for somebody to market this product. And we have been aggressively building a network across the country of facilities to work with on a national level. And the next stage in the process would be to expand distribution, and secondly, target in a controlled fashion producers at sort of the local level healthcare facilities. So my expectation is, as the broader rollout is probably going to happen towards the end of the summer months, at which point in time I think we'll have felt that we've kind of got the learnings that we need out of this pilot process to expand the market broadly. I do think that we were at the ILTC annual meeting this year, and this product probably got more attention or buzz than anything that occurred in the meeting, and there's a big interest in it. So I would say it's still a few months down the road, but we're certainly interested in knowing which general agents in our distribution world want to market the product, and then from there we'll identify agents that want to participate, and then get them involved in going through the appropriate training so that we can ensure that we are providing this solution in the most professional way.
Thank you very much. The next question comes from Maria Tobin. Maria, I'm going to open your line and let you ask your question. You there, Maria?
Yeah.
All right, go ahead and ask your question to Anthony.
Pooh.
All right, Anthony, her question was, how will term conversions be treated going forward?
In the same way as they are today. Obviously, people own term insurance with Genworth. There is a provision in their contract that allows them to convert to our Life Ready 2 product, and they will follow the same procedures that we have in the past. The only question for us at this point in time is, we're looking at, from a quoting perspective, how do we meet the needs of our, our distribution partners. Right now, WinFlex is the tool. We're debating whether or not we want to have our own conversion quoting tool, but if that doesn't occur, we'll just continue to, at the point right now is to leave WinFlex up and running so you can run term conversion illustrations, and I don't think that will get pulled. Certainly if it did, our team on policyholder services can run the illustrations. I do like the idea of the producer being able to do it on their own, so they can control when it's done and how quickly it's done. So, but conversion process is the same, and commissions, based on whatever your commission arrangement is today, is what the commissions would be. Whatever arrangement you have with Genworth for commissions today is how you would get paid on conversions moving forward.
Okay, thank you. Next, I've got a question from Cliff Corley. Cliff, I'm going to open your line and give you a chance to ask your question. Cliff, are you there?
Yeah, I'm here. She just asked my question for me. I was concerned about the conversions, and I was also concerned about the position of the GUL, but I assume that you're going to honor that contract.
Oh yeah, absolutely. And there's a number of different universal life products that we've sold over the years that are on the books. GenGuard being the most notable. No, those contracts are fine, and as we've said you know, there are contractual obligations in those contracts that we have to maintain, and that is our, you should have that expectation. It's what we're going to do.
All right, thank you so much. Cliff, did you have a follow-up to that, or was that your...
No, I appreciate it. Thank you for your time. I appreciate you doing this conference today.
Oh, you're very welcome, and thank you for your interest.
All right, next I've got a question from Ken Mathis. Ken, I'm going to open your line and give you a chance to ask your questions. Ken, are you there? All right, well, Ken sent his question in. I will ask it for him. He had some follow-up questions on, he said it sounded like at the beginning of your conversation that there was, you know, that I guess he wanted more information on how you balance the compensation piece as a problem in the profitability of the book of business versus the payouts to stockholders.
I guess the way that you look at that is that when you price a product, there's a number of factors that go into, you know, what your ultimate premium is going to be at a consumer level. And one of those factors for sure is what your acquisition costs are, which include, and probably the biggest part of it, is the commissions that are paid, the compensation formula that you have. And so by the time you agree on what you're going to file at a state level, your product, you figured out, you know, the combination between what I describe as your commissions, the premiums paid by the consumer or your rates, and also I think you could factor in your underwriting, because underwriting really contributes to pricing, right? And so at the end of the day, when you put all of those things together, you're not launching a product that doesn't hit a required margin or profitability standard. You know, obviously some assumptions can change over time if mortality improves, if morbidity improves or gets worse. I mean, all of the interest rates change, and that has an impact particularly on new products, but it also has an impact on the performance of your in-force block. But you know, some carriers will lower commissions simply to create more margin or to create more competitive consumer pricing. So, you know, for us, you know, when we build new products and products that we have out there today, you know, those products ideally, you know, when you sell a product, you're kind of committed to the compensation schedule when that product was sold. Where you make changes is really on products that you're going to sell. So, as an example, if in a long-term care product has a 10% renewal or has an 8% renewal, whatever the renewal is, that's lifetime in the contract, that's what's going to be paid. Now, that doesn't mean that we will have the same, you know, renewal streams built into future products, but, you know, as far as, you know, renewals, you know, we have a day one vested contract. You know, it's not something that people need to worry about.
Okay.
We need to be competitive to stay in the game. So, you know, with what we're selling today, our compensation is very attractive, and we need to be.
Okay. There was a follow-up question, and you may or may not be able to answer this one, but at one time you were trying to sell the block of business, and they just wanted you to comment on what happened and where you are in the process, if you can.
Yeah, I can. So first of all, we declared publicly, so it's okay for me to share this, that we were looking at a variety of options related to our life and annuity business. And as some of you will know, that we did sell 16% of our in-force term block. Now, I say sell, it really was a reinsurance transaction between Genworth and Protective Life. And the simplest way to think about that was, you know, we traded future renewals for upfront capital. That was the trade. And it's almost like we basically monetized our renewals on 16% of that term block, and we retain 100% of all of the servicing, the reporting. Like, so to a policyholder, there's zero change. A policyholder, if they want to convert, can only convert with Genworth. They can't convert with Protective. Statements, commission payments, all of that. Nothing changes except the way that this transaction flowed in terms of renewal income, renewals, and as far as getting capitalized or monetizing that business. Those types of transactions, there could be additional transactions in the future. I'm not aware of any that are pending today. They're not easy to make happen, so it's not like you can readily, just go out there and do those types of deals. But certainly it's within possibility, and we chose not to at the time for, I guess one primary reason is that due to a few factors, we didn't think that doing a whole-scale sale of the life and or annuity business at the time represented the best decision for our company, and that's what the board believed as well. And so we did have some choice to make, and we made the decision to keep that business. I really don't know what's going to happen with the life and annuity business moving forward. What I can tell you is that both of those businesses make money. We generate profits. It's important to us to keep those assets. We don't want to run on the bank, and that's why we got to provide good policyholder and agent or advisor service, because we do want to protect that asset. So, but as far as any potential acquisitions in the future, I think it's hard to know.
All right, our next question, Anthony, comes from Max Harbuck. He just wanted some more, wanted to know if you would comment on future long-term care rate increases. His question was basically from the perspective of, as clients are evaluating this and the financials are what they are and the claims paying ability you say is still good, but what kind of information can he share with his clients as to what you expect to happen going forward with the existing long-term care policies?
Yeah, so I think you got to break this into almost three buckets. There's what I would describe as the pre-2001 business, and then there's 2001 probably to about 2010, and then the business sold thereafter. The business that's really the most problematic is pre-2001, and a lot of that business was business that we actually acquired, and the performance of those blocks of businesses have been, very subpar. We lose money on those blocks, and we lose substantial dollars on those older blocks of business, which has necessitated and warranted the need to do enforce rate actions. We've been successful, with about 45 of the states in showing them the financial data that has got the regulators comfortable with approving rate increases, and in some cases the rate increases have been, they've really been a wide range. And so sometimes you have a state that will say, I'll grant you a 20% increase in premium for now, and you can come back next year and ask again, but you're only getting 20% now. You'll have some states that will say, I'd rather you just kind of deal with it at once and do what you might need, and you'll see in those cases a much higher increase. And as long as we can demonstrate that we're losing money, and all we're really trying to do is to break even, and that's a challenge in itself on a go-forward basis. We're not trying to make up for the losses of yesterday. That money's sunk cost. We're trying to get enforced rate actions so that we can, on a go-forward basis, get close to break even. I think that if you look at the business sold between 2001 and 2010, there's still challenges with that block, but not nearly to the extent of as there is to the older blocks. And then I think when you look at products that we've been selling in the last few years, they have been de-risked pretty substantially. We've taken the lapse assumptions from 5 to 6% to the ultimate lapse assumption being, less than 1%. Interest rates and expectations around pricing have been lowered to be more reflective of the environment for which we live in. Of course, if interest rates would ever go up, which we've all been thinking was going to occur for probably the better part of 10 years, if that occurred, it would take a lot of pressure off of pricing and, quite frankly, the need for future rate increases on the newer business. And, I think that, the elimination of certain benefits have also capitated the risk to the carrier. So we have very conservative pricing. And I think I think you could look at it and say, will I ever have a rate increase with the products that are being sold today? I would definitely say you can't say never, but I do think that that the strategy would be they'd be much smaller, probably single digit, and we would act more swiftly than we did in the past. The regulators, one of the things that they are upset with the insurance community, the carriers specifically, is that the carriers, including Genworth, waited way too long to take action. Those problems were there, and every 5 years you wait to address the, let's just say losses on the in-force block, doubles the amount of increase that you need to seek from a regulator. And so, if there was a problem for 20 years, you know that you have a very substantial rate action. And as assumptions became, we better understood the business and assumptions applied to the back book or the old book of business, those individuals, quite frankly, they're upset about higher premiums. I don't blame them. However, they still have tremendous value in the contracts that they're buying. So, I've had a number of people that I've spoken to who have said, geez, I've got a 60, a 70, 80% increase, and I asked them to do the math. And, in many cases, it's translated to, the equivalent of a 2 or 3% increase over the course of the contract. Or they look at it and they can say, well, based on the benefits that I have, even with this increased premium, it's still an incredible contract. And it's still a lower price than the product I could buy today on the market. So not happy about the increases, but it's necessary. And so I think, the increases on in-force blocks of business will continue. I think you got to think about it more like the health insurance business, and I think you should feel comfortable in current pricing because the level of risk capitation in the products over the last 3 years was significant, and we would not expect the same sort of experience moving forward.
All right, well, we have reached 11 o'clock. Anthony, we thank you very much for taking the time to join us and answer questions, and we appreciate all of those of you that joined us as well and had a chance to ask your questions. Continue to check back with us as there is more information available. We will make it available to you. And again, just wanted to remind you, upcoming events next week. On the 19th, we have a webinar for the DOL ruling. We also have a lunch and learn here on the 21st. And then May 13th, we have our open house, Low Country Boil, live music, great food, prizes to give away. We hope you and your family will plan to join us. Thank you so much, and hope you all have a great day.